Hi everybody, I am Dr Sudipto Ghosh. Welcome you to Knowledge School. I am going to present you the video series on mutual fund for beginners. The series will come in 4 modules or 4 parts. The first module will cover the following topics: origin of mutual fund in India and its phases. What is mutual fund? Ownership of mutual fund. Why mutual funds? The entities in a mutual fund. The agencies who are involved in the mutual fund process, that is sponsors, a trust, trustees, custodians, asset management companies, register and transfer agents. Mutual funds are ideal for investors who wish to earn higher returns by investing in equities or other asset classes such as government securities, corporate bonds, debt instruments, etc., but do not have the necessary time, knowledge, and skills to manage their portfolio well. Mutual funds provide an excellent channel for such investors to attain their objectives without assuming a higher level of risk. Hope you will share this video and subscribe the channel. Origin of mutual fund in India. In India, the first mutual fund, although not known as a mutual fund then, floated was the US 64 scheme of the Unit Trust of India. The first mutual fund in right earnest was started by the State Bank of India in 1986. The first phase of mutual fund comes in India in the year of 1964. The Unit Trust of India was established on 1963 by an Act of Parliament. It was set up by the Reserve Bank of India and functioned under the regulatory and administrative control of the Reserve Bank of India. The first scheme launched by UTI was Unit Scheme 1964. The second phase of mutual fund starts in the year of 1987. Where the entry of public sector funds can be seen. Entry of non-UTI mutual funds, State Bank of India Mutual Fund was fast followed by Can Bank Mutual Fund, Punjab National Bank Mutual Fund, Indian Bank Mutual Fund, Bank of India, Bank of Baroda Mutual Funds. Likewise, the third phase comes in the year of 1993 with the entry of the private sector funds. With entry of private sector funds in 1993, a new era started in the Indian mutual fund industry, giving the Indian investors a wider choice of fund families. The 1993 Security Exchange Board of India mutual fund regulations were substituted by a more comprehensive and revised mutual fund regulations in 1996. What is mutual fund? A mutual fund is an entity that acts like a collective investment vehicle. A mutual fund is a financial intermediary that pools the funds of a large number of investors with similar investment objectives. The ownership of the pooled funds lies collectively with all investors. Ownership of mutual fund. The extent of ownership is defined by the number of units allotted to and held by each investor. The units of mutual funds are of a predefined value, usually Rs 10. Each unit represents an equitable right of the investor to assets of a mutual fund scheme to the extent of his proportionate share. At present, there are 44 fund managers active in the mutual funds market, with the assets under management amounting to 8 lakh crore rupees. Why mutual funds? Professional management of a funds may provide higher returns. Risk is reduced due to diversification by fund managers. More convenient to you, need not monitor and rebalance your portfolio from time to time. More tax efficient than fixed income investments like bank deposits. Mutual funds are having adequate liquidity, lower transaction costs vis-a-vis direct investing, and the facility for switching from one scheme to another as per convenience. It has also the facility of building up a portfolio by making small, regular investments through systematic investments plan, which is known as SIP. Availability of a variety of schemes to fit almost every investment objective. The entities in a mutual fund. With the adoption of the SEBI mutual funds regulations in the year of 1996, mutual funds were brought under the supervision of SEBI. These regulations govern the legal and operational structure of mutual funds. The agencies which are associated with the formation and operation of mutual funds are given in the next slides. Sponsors. The sponsors are actually promoters of a mutual fund. A license to promote a mutual fund is granted to only those entities that fulfill the norms prescribed under SEBI regulations. A sponsor has to take a specified stake in the asset management company or AMC and has to appoint the trustees. However, a sponsor is required to keep itself isolated from day-to-day operations of the AMC. A trust. The mutual fund is formed as a trust under the Indian Trust Act 1881 to be registered with SEBI. The beneficiaries of such a trust are mutual fund investors. And who are the trustees? A minimum of 4 trustees must be appointed. Trustees are responsible for ensuring that the investors' interest remains safeguarded at all times. Trustees can be individuals or a corporate body. Regulations require that at least 2/3 of trustees are independent and not associated with the sponsors in any manner. Thus, regulations ensures that the trustees discharge their role in an impartial manner. Now comes custodians. Custodians are different from the AMC and sponsors. Custodians are responsible for keeping custody of various securities in which the mutual fund scheme has made its investments. The custodians maintain records of all investments. They collect dividend, interest, and other income on such investments. The custodians are responsible for maintaining separate records for each different scheme. Now let us understand the asset management company. The trustees manage or appoint an asset management company which is an entity independent of the sponsors. It acts as an investment manager and is responsible for all operational matters such as devising and launching investment scheme, managing investments, handling investors' grievances, and other operational aspects. An AMC is required by SEBI to have a capital of minimum 10 crores rupees. It must be registered with SEBI as a portfolio manager. The stake of sponsors in an AMC should not be less than 40%. The AMC is paid a fixed fee of 1% to 1.25% per annum of the managed assets as investment and advisory fees. An AMC, it engages the fund managers for various schemes to make investments, track markets, and redeploy funds from time to time for getting good returns for investors. Now, let us discuss about the Registrar and Transfer Agents. The Registrar and Transfer Agents handle investor-related day-to-day services such as redemption of units, additional investment, systematic investments, withdrawals, transfers, sending statements, ensuring KYC compliance, distribution of dividends, etc. Presently, CARVI and CAMS, Computer Age Management Services, are registrars and transfer agents for nearly 75% of the mutual fund schemes. Hope you have been able to understand the basics of mutual funds. In our next module, the following topics will be covered: how to invest in mutual fund, new fund offers, purchasing unit of existing schemes, NAV, the net asset value, entry and exit loads, dormant accounts, redemption of unit, statements of accounts. I expect you will be able to subscribe the channel and share this video as much as you can. Thank you.